Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, November 29th, 2023. It's 11:51 a.m. as I'm starting the video, and I'm going to do things a little backwards. I'll tell you it won't be a long video. Sometimes I say that, and it is. This one, I'm just going to show you a few things, things I think are most important right now for the equity markets. And I'm going to do it backwards because I'm going to start out, I'll wrap with the equity markets last. Again, I'm not going to show you a lot of charts, just a couple of pending and recent sell signals that we had. And I'm going to start out here with the euro. So really yesterday I got a post out to you and I call it now the big three. We have such a strong correlation between the currency, the major currencies. You can look at the US dollar, flip it upside down here as I did with the euro US dollar pair. So we're watching that. High correlation to the stock market, meaning they go up and down together. I showed you that yesterday. You can check that video if you missed that one. It's an unmistakable correlation. And sometimes you can actually get a little heads up when the currencies turn first. And same thing with the bond market as well. So we have as I've said recently, for last few months with bond yields, pushing multi-year, even multi-decade highs, the stock market is hypersensitive, is and has been. So, 110% of the rally that we had in the stock market over the last few weeks was attributed to both an actual abatement in yields, rates coming down, as well as expectations for additional downside. So, there's real and perceived. The perceived part is the vast majority of market participants believe the Fed is finished hiking rates, and the rates will also continue to come down, and the next move will be a cut. So that's the perceived part. Now that can change, but we know the real part is the drop in rates. So, all right. Anywho, this is the euro US dollar pair right there. We have this nice divergent high right here. There's a uptrend line, gives us a bearish rising wedge. There's our divergence. And so we're starting to crack below it. Not a solid breakdown yet. Minimum target right there, second target, third, and potentially fourth. If you want to jump out to a 2-hour time frame, you can kind of see how it looks here. So there's your wedge, just like you had a divergent high here last time and a divergent low there, and that gave us that rally. And told you I did it yesterday. I'll just do it takes a second. Throw up QQQ or SPY, you'll see the very unmistakable correlation. So if this chart plays out the way that I expect it to. Again, it's pretty clear. Divergence is not a sell signal, I always say, but a break of that uptrend. I do want to add that's not the best defined trend line. It's not bad either. We have enough reactions to validate it. So that's that. Watch it. Again, it looks imminent. Oh, and you also have, that's why I zoomed out to this 2-hour. You have some resistance. It's not super solid resistance, but it is resistance nonetheless. And so the euro just hit that resistance level and is turned down. So if we see the euro continue to drift lower, it's down today, and hit either of these targets, you can, these are levels where you're likely to see reactions. And so you can incorporate this into your analysis if you are trading the equity markets, whether it's the S&P 500, QQQ. All right, that was QQQ I put up a minute ago to show you how they mirror. Okay, let's move on and look at Treasury bonds. We have the 10-year, 7 to 10-year Treasury bond ETF, that's IEF. And this is a line I've had here for quite a while, the price target. Created that back on August 2nd. You can see there it's at 94.24-ish. And we pretty much effectively hit that target. We did so with negative divergence. And more importantly, is TL. Well, I should say the 10-year is an important one, don't get me wrong. But this is what the trade that we've been in. In fact, this one goes back to, this is the live chart, but I first posted that and listed, Treasuries is one of my favorite trades, overweighted trade. TLT was suggested with a double position size because, bonds are typically less volatile than stocks. And we nailed the bottom. There was the setup. This was dated October 19th. And you can see in the arrows I had drawn at the time, solid arrows. When I do that, the dotted is like, Yeah, maybe, and that's a max target up there. Still is the 95-ish level. You can see there's horizontal price resistance and the downtrend line, which I'll get to a live chart in a second. But the three solid arrows, those are my high degree of confidence targets. That's why they're solid arrows, and not I dash that and I take the brightness down a little, saying that's a potential max target. But here we are today at that level. So this to me is very important. Last week I thought we might not get all the way there. We were close, and now we've actually hit it. So as I often say, I list multiple price targets because there's odds that each one is hit. As each one's hit, the odds of reaction are good. The fact that we're at this one now, remember this T1 we gapped above, and that was bullish in itself. Resistance is resistance unless taken out. It was taken out on a gap, and so that opened the door for a move up to T2, which was hit. Then you got to pull back to about T1 right there, if you support, and then we rallied up and hit now T3. So my point is there's a good chance of reaction. This is resistance. It's the first tag of a resistance level. And I like nothing better than a rally into resistance that has negative divergence and or overbought conditions, both of which are present here. Here's your RSI. We've been overbought. We've been diverging as well. And that's even better instead of a single overbought reading, because usually that first overbought reading in an uptrend is followed by a second lower overbought reading. So either way, high probability of a pullback in treasuries. And if I'm right on that, if that does happen, then that would most likely or almost certainly correlate to a pullback in the stock market. I'm going to put a little line here. If you are trading it, it's about 89.65. That would be, I'll just color it up since it's not one of the upside price targets. That would be a minimum pullback target right there. And that'd be roughly in line with the, let's see, the measured target of the wedge. If you take a widest part of the wedge right here, let's do it right here. And there's your widest part. Add that to where the wedge breaks down. And that would take us out, actually take us back to about T2. If, and it's possible, remember divergences, one thing I always say is they're not sell signals, they're merely conditions that indicate a trend reversal or pullback is likely if they're negative divergences, just like we had positive, aka bullish divergences at the low. And there was, of course, our breakout. That was a chart I showed you right there. There was our breakout. But these divergences can and often are extended and then end up playing out for an even larger move usually. And there are times where in a strong uptrend, the divergences extend, and then once the previous highs have been taken out, you no longer have divergence, and that's pretty damn bullish. So, I can't rule that out. Me, I was super bullish on treasuries recently. I've kind of backed off, told you I booked some profits the other day. May still take some, well, now that we're at T3, yeah, I think there's a good chance. I'm thinking it through, because here's the thing, guys. If you remember, you can tell from the hesitation in my voice, I expected and still do sort of a gradual handoff, if you will, from that strong correlation between stocks and bonds. In other words, if the stock market starts to turn down, and there's a couple things that can do it other than the technicals, of course, and the fundamentals. We've got a lot of stuff on the economic calendar still this week, but that's going to show softening economic growth, lowering economic growth expectations and or increasing the odds of a recession, which should typically brings rates down, and that makes bonds go up in price when rates fall. So that's one scenario where you can see that the tight correlation, because historically stocks and bonds had an inverse correlation. Lately, they have a strong positive correlation, meaning both going the same way. So again, I am expecting that. And another way to say it is I'm solidly bearish. Nothing's changed my outlook on the equity markets. In bonds, they still, look near-term bullish. The charts are constructive. Again, I think we milked a lot of this initial leg up, probably correction coming, and could possibly be the end of the run. And that's why, I've taken some off and may take a little more off. But at this point in time, I could certainly see, especially if we get a correction first, a little more upside in bonds. And that could also occur with stocks falling. Remember, so it's not just the slowing economic expectations. If that comes to fruition. Right now, everybody, the vast majority are bullish and, have eliminated the recession. Even the soft landing scenario has kind of been taken off the table by most. And I'm still looking for a pretty hard landing sometime in 2024. And so if that happens, again, you could see, and you almost certainly would see stocks fall, but it is possible to see bonds go up for both a flight to safety bid as institutions and individuals move money out of stocks into more secure treasury bonds, as well as falling growth expectations. So that's that. Okay, and that leaves us to the equity markets. I'll start with SPY, and then I'll spend a little more time on QQQ, and we'll wrap the video up. This is a 60-minute chart. So I just moved the lines. It's like football, right? You get a first down. What do? They take the first down markers, they move it. And so that's what I'm doing with my divergence lines. So nothing's changed for weeks now. I know some of you are probably tired of hearing it. Typically, that happens on the site. And, I'm pointing out developments, bullish or bearish, and sometimes they take a little longer to pan out, meaning the trend reversal. And that's when usually I start to field some snide comments about divergences. And I always say, they don't always work. And so, it shouldn't be, all your eggs shouldn't be in one basket. It's not an all-in short moment, but I'll tell you, it's getting close to it now. And I'm going to show you the things in the charts that make me think that we could see a big drop coming up here really soon. So there's the primary downtrend line. That was the breakout. It occurred in a big old gap right here on SPY, which is a natural target for a pullback at minimum, especially based on the scope of those divergences. So on SPY, if you are a SPY trader, from today's high, which has been faded mostly, that would be a drop of about 2.7%. And if that gap is backfilled, when I'm talking about, again, this gap right here, the breakaway gap that took out the trend line, that would be a drop of about 3.7%. And then a full back test of the trend line, well, that would depend on if and when we tested it, because trend lines are dynamic. They come in at lower and lower levels if it's a downtrend line every day. So it depends on when you get there as to what that drop would be. So either way, that's a minimum pullback. Again, minimum would be a backfill of the gap, and that's 446. If we enter the gap, chances are you go to the bottom of the gap, and it would be just very, very ugly, in my opinion, to see these trend lines again. These were the trend lines off the July highs in both QQQ and SPY get taken out. Now, I suspect they will, and I'm going to, let me roll into QQQ and tell you. I believe I said this a week ago, maybe even 2-3 weeks ago. If you have to define, first of all, assuming you even agree with my analysis on the market. Now, what I do is I provide analysis. I provide key technical levels, support, resistance, point out other developments, both current or developments that have happened and developments to look for. And you may, share the same outlook, let's say, on gold or treasury bonds as I do, but you have a completely different outlook on the stock market. Well, that's up to you then. If you are bullish, then the same levels that I'm pointing out to watch, here, let me give you the targets I gave you the other day. In other words, these are the targets I laid out this week. Was it this week or late last week? Minimum pullback targets here. And so instead of shorting and you're bullish, you might just want to wait to pull back to that T1 level. It's a very obvious gap. You'll most likely get buyers stepping in there, not guaranteed, but that's an area you could go long. And if that level fails, or you think you're going to get a little bit bigger pullback, then you have this second level here, which is that potential uptrend line. Potential because there's only a couple reactions there. We need a third confirming reaction, or at least one more. But that would come in roughly with the backfill of the gap, again, that big gap right there. And then, of course, T3 is a back test of the trend line. And those are all objective levels for someone who's longer term bullish to step in and buy. They're also objective levels for an active trader that wants to short a pullback, that believes we're just going to pull back for a little bit. Those are objective levels to cover. And they're also objective levels to if you're a longer term if you're longer term bearish on the market, like I am. those are levels to watch if and when taken out, because we go down here and we take out T1, you enter the gap, you're probably going to backfill the gap. If you take out, if we come down here and in a back test of that trend line, whether we get a back test or not, if that trend line fails, meaning we fall back below there, that's going to be very bearish. That will be picked up by not just me. I'm sure there are a lot of folks that can see these downtrend lines. You can see them on the daily chart. Very, very obvious levels. Okay, so now let's just focus on this daily time frame. Again, the 60-minute charts, as I just showed you on SPY and QQQ, just about all the indexes have the negative divergence, as do Treasury bonds, as I just showed you, and the US dollar, really the euro, which is the inverse of the dollar. So on the dollar, you have positive, aka bullish divergences, right? Because the dollar and the stock market they work inversely. So you can go to UUP and you can see the positive divergence. So that means if the dollar rallies, stock market goes down. Okay, now we're on the daily chart. It's a little bit of a busy board. Let me see if I have a cleaner board for you. I've got all kinds of stuff all over here. Let's just work off this busy board. Okay, so we now have, which was listed, created this back on September 18th. So that's over 2 months ago. And all along have maintained, I had a primary scenario that this would be the high in QQQ and we'd continue lower. And we had some corrections, bounces along the way, including this one here. Expected to bounce right there off the 200-day moving averages and all those key support levels. But that alternative scenario, which obviously now, since it's happened, has become my primary scenario, right? It's one I couldn't take off the table and didn't. And so now we have it. And so the takeaway is that is still very much, what I think is best case scenario for the market. Even when we were back here, I described it as being still a longer term bearish scenario, just near term bullish, then longer term bearish. In other words, we come up first, get that takeout, make a slight marginal new high, again, anywhere, within typically around 5%, give or take, and maybe 8 max. But I'm leaning towards, not even that much. In other words, this could be it. And what I'm looking for is another or some decent type of sell signal. So let's talk about that right now. As I showed you yesterday, there's quite a bit on the economic calendar this week that could be the fundamental catalyst for a reversal. But let me flip over to this board here, and this is the one I've shared recently, what I call my low volume indicator. And it's this purple line. It comes in about 40. What is that at on volume? It's the 10-day. It's that blue line that you can see is crossed down through about 44.4 million shares. And it's had just one whipsaw right here, as I pointed out before. Other than that, since the bear market started, that's when we peaked back here. There's the beginning of 2022. 1, 2, 3, 4, 5, 6, and now 7. So far, this indicator, this is yet to be seen. Only time will tell. If we do go down from here, then it's going to be 6 for 7, which is a pretty damn good success ratio. If the market powers on through here and goes up, another 5, 10, 15% plus, then it's just a whipsaw and it doesn't work. And as I mentioned before, at different periods in time, you have different, the 10-day moving average on volume is going to change. So this is a dynamic indicator that you can see. I have lines from in the past that I've used to recognize those low volume sell signals in different market conditions. But this is where we're at now, and this has been the magic number. So as I mentioned, that triggered last Friday on the cross down and had a daily close below there. That's what it has to do. It's and so you can see it, and the volume continues to drop, which is also it's similar to using the divergences, because the divergences that I use on the PPO and RSI, those are momentum indicators, so they show you the momentum's waning. And in this case, it can show you that the volume has been waning. So stocks are lifting up. Fewer and fewer buyers are lifting stocks up. What happens is the short sellers are afraid to short. They've covered. There was probably a massive amount of short covering in this rally, I imagine. And so that opens the door for, another move down when you blow out a lot of that short interest. So either way, that's about the only decent sell signal that I have on the market. I wanted to point that out. There's not really many right now. Normally, like back here, if you remember, we had that showed better on the 60-minute chart. We're on a daily right here, but that was a bearish rising wedge pattern there, and again showed better on the 60. That was our initial sell signal, for this whole leg down here. And of course, we had rallies into resistance, the downtrend line, including that one. That was a very profitable short entry highlighted there, swinging down here. That's where I started covering all my shorts. It was about a day or two early. Started scaling out of the shorts and into longs, and went long. Admittedly didn't stay long enough and started shorting too early, but that's fine. Nobody bats 1,000. But again, we've come full circle now. We have that marginal new high. And so where I'm going with this is I don't have, like I showed you on the 60-minute chart, what I can show you is we had a similar technical posture. This is a different board than I was showing you a minute ago. I was showing you this board here with the price targets on the 60. But you can see I don't have a really nice uptrend line or even horizontal support level other than T1 to really trigger a sell signal from price. But what I did notice on this board, I added this line today. If you look back here, I'm going to go back just a little bit and zoom back here. You can see at this point you had a pretty strong advance as well, and you had an uptrend line right there that was broken, but you pushed on up. You didn't really have divergence, but then you made another thrust up and put in a divergent high right here, at least on that smaller right here on these two peaks in the RSI and PPO. And then the turn came, right? So again, you had a pretty steep uptrend line breakdown, another thrust up, and that's similar to what you have here, just on a bigger scale. You had a somewhat of a fairly well, not super well, but a decent trend line, enough reaction points to validate it. And then another thrust up, it back tested below, and here we are. And all that's done is simply extend that divergence. So again, I wish, I'd feel more confident if we had a very clean, very well-defined uptrend line, but as of now, we don't. However, we do have that support level there, the top of the gap around 383. Again, it shows better on this board, T1, 383.41. And so a break below there would be a sell signal as well. But, all sell signals don't have to come in price. There are other types. What we have here, we still have, remember I pointed out, I think it was last week, the potential for an island cluster top. Okay, so what an island cluster top is exactly as the name implies. You have a cluster of candlesticks that form this island, and you have to have gaps on both sides. So there's a gap right there. And if we were to gap down, a pretty significant gap. You don't want to look at a tiny little gap. You want it to be, pretty distinct. It leaves that island of candles there. We even had an island. It wasn't the most textbook looking one, but there were gaps on both sides of this island right here. And then that really was, marked that whole move we had down from the July highs to the recent lows right there. So just pointing it out that that's still a possibility. So if you see that, this island's getting a little bit long in the tooth. It's still well within the range of islands I've seen in the past where you had an island top. But if you trade like this for another 2 months, it's going to just be too long. So it's really would be ideal to see that within the next week or so here. Sooner the better. And again, it's just one potential thing to watch for. Now, something else we have, there's that low volume. You can see it clearly here. The volume just tapering off, on this rally up. You can see that fewer and fewer buyers. The market's being lifted on fumes, and it's also being lifted by the Mag 7, as it's been pretty much all year, as a lot of other stocks are still trading below their 200-day moving averages and all these key levels. Okay, so to wrap this up, in addition to the fact we do now have that marginal new and very much still divergent high, we also have a pending, it hasn't happened yet, but it's a potential sell signal, and that would be a bearish crossover, a high-level bearish crossover of the PPO. So let me show you that. Okay, I'm going to turn off all the lines. I'm going to put up a PPO histogram, and I'm going to put it separate from the PPO itself. For those of you not familiar, you can overlay it on under. So a lot of charting programs will put it right behind the PPO. But the PPO histogram, as any histogram does, it just shows you the differential. In other words, the distance between the two lines, and that is your signal line, the white line, the 9 EMA. And if you don't have a PPO, you can do this with a MACD. They're very similar. They're close cousins, I call them. And so you have the PPO line, and that's in orange. They just use a slightly different calculation method. I just prefer the PPO over the MACD in most cases. All right, so you see the PPO line is moving down, poised to, although it hasn't yet, but poised across down below the signal line. And again, that's evidenced in the histogram because that's what the zero line does. Right here in the middle, that white line, that's when the two lines cross. And so you have what they call a bullish crossover when the lines cross, PPO line crosses a signal line, and that's when the histogram goes from red to green. And then you have a bearish crossover. And so what I've done here, and put up these lines, and I've shared this many times in the past, I have, and again, I make a lot of stuff up. I don't know if it's proper terminology, but I call these high-level bearish PPO crossovers. By high level, get high well above the zero line when the PPO is well above its zero line. So what I've done to illustrate that, and what we can do is just park the rest of them for now, just give it a little more room in the video. So here's the PPO histogram right here, and you can see, remember this bear market started back here. There's the bear market. Technically, the high in the NASDAQ was November, but you had an almost equal high right in the beginning of the year in 2022 when the S&P 500 and all the other indexes peaked. So that's a start. So we're going to go back there. And in fact, you can see, now you can go back as far as you want. Here's that purple line. And so you can see some extreme readings. So what I look for, I call them big green hills. Again, they're high-level bearish PPO crossovers because the PPO got very high. It's above the zero line, as I showed you a minute ago. And so what I've done is this is a big hill. These are just little hills. These are crossovers that came, when the PPO was closer to the zero line. But here are your high-level ones. So let's just talk about going back for the last few years and even go back into the bull market. We didn't have any until right here. This was the first one where we had a big green hill that hit that level. And there was your bearish PPO crossover. That was right here. And that was a pretty damn good sell signal. It got you short, got you out of your longs if you gamed the bounce. We did. We had positive divergence. We were long on that rally. We were short off the highs. And by the way, you did have a high-level bearish PPO crossover right in the beginning. So here was a big green hill. There was your crossover right there. Came right at the highs, right around the highs. That was a whipsaw. When you see little hills like this, ignore them. Little hills, and it works in reverse as well, guys. These are big red hills. I call them inverted hills. And you can look, that's a whipsaw, but then there is a trend change. So they're pretty darn accurate buy and sell signals. Again, if you filter out, because you're going to get, the PPO is going to hug closer to the zero line and sloppy periods of consolidation and all that. So when you get these big green hills like this one that we have recently, it's because you have a nice trend, a clear bullish trend, and that's what makes the hill so high, if you will. So, all right, let me just draw it out for you. So there was a clean crossover. There was one right there, and that one didn't do much, but we were already coming right off the, right down off the lows. We just had a recent bullish crossover. We'll call that a whipsaw. But here was the next one right there. You can see what happened. I mean, these are all double-digit drops. There's one right here. That's a whipsaw for sure right there. Like I said, no indicators. I often say no indicator is 100% accurate, but there's another sell signal. Boom, nice drop. Probably double digits again. And another one right here. And it caught most of that drop. And that's it. So my point being, this is the first big green hill we had since this market was in that very powerful kind of bear market mode, what a lot of people think was a bear market that's over. I still maintain this has just been one heck of a bear market rally with another leg down to come. We'll see. Time will tell. But what I can tell you factually is that we've hit that level. We're up at those high levels there, and so you need to watch for this. Looks imminent, and you can kind of get ahead of these. Sometimes the lines look like they're going to cross and they don't. Here's when we were going down, then there was another reprieve, but then it came. But for the most part, when the momentum turns, again, we're looking at momentum indicators. You can see the momentum waning. You're still going up, but the momentum's waning, and then you get those crossovers. And so you can see, again, it appears imminent. You can also look at the size of these hills, how long they last. You can see, all right, this is not rocket science. No uptrend lasts forever. It's just the nature of the markets. Even in a strong bull market or a strong bear market, you're always going to get your counter trend rallies. The market gets too overbought or too oversold. And so you can see that this one's long in the tooth. It's about as long as these green hills typically get, or at least in the well into the longer end of the average range. So that's that, guys. And so it'll be when you get that crossover, that will be another sell signal. We already have the one, and on the low volume indicator, and if we had a big gap down sometime soon, that would be another sell signal. And so trading strategies. Let me just end with that. You could be short now based on the low volume sell signal and these divergences. You'd have to give yourself a little more room. You can't be aggressively short because you don't have any solid sell signals. This is still a strong uptrend, and despite the declining volume and everything else, again, the trend is bullish right now. So maybe a partial short position, you got to give it some room on your stops, in my opinion. Or if you get a hard sell signal like a gap down, and you confirm an island top. Those are beautiful. I love island tops and bottoms because it's simple. If you get a gap down, set your stop just above the island. Remember, island cluster tops or individual island candlestick tops, when you only have one candle, when they come after a prolonged uptrend, they are topping patterns. They're not pullback trade patterns. Okay, what I mean by that, I give you pullback targets here on the 60-minute chart. What they typically do is mark a lasting top or a lasting bottom, just like bullish golfing candles. We had that on the markets as well. You had a bearish engulfing candle, which is a topping stick. It's not the same as an island cluster. It's another type of reversal, and that certainly marked a top and gave you the biggest drop we had all year. And just like we had a big bullish engulfing candle, I pointed out at the bottom. So these candlestick patterns are an alternative, another way to get buy and sell signals. And again, there's an infinite number of possibilities. We could also get, maybe we don't get an island cluster top, but you get a big bearish engulfing candle, would look like that, big and red. And then those are also excellent RR trading opportunities. By that I mean it's very simple. If you get a bearish engulfing candle, just like a island top reversal, put your stop just above it, because if you go above it, any violation, any move above it, it's no longer a topping stick, because as those come, they're potential topping sticks. And so you can have a very tight stop if you get that. And what you want to see, you can have green candles as long as they don't move above there. And then again, just remember that if you're trading a topping pattern like the bearish engulfing candle or the island cluster top, they're calling for a trend change, a major top, maybe potentially the end of the bear market rally, potentially. So your downside potential is huge. But again, you still want to maintain that discipline of a relatively tight stop. So it gives you, they're rare. We'd be lucky to get it, and even luckier if it plays out. But my point is, the risk reward ratio is phenomenal in those things, because if you have the wherewithal to take the trade, first of all, and just again, your loss is minimal if you're stopped out, if it doesn't pan out. But if you have the wherewithal to let that run, because hey, I got a short at what I think may be the top end of a bear market rally, and if my analysis is right, and I'm saying if you're saying this to yourself, or you want to say if my analysis is right, however you want to say it, and we're going to go down and we're going to take out the 2002 lows, and go quite a bit lower, I mean, you're talking, I still have my weekly targets are minimum on QQQ. Minimum, I think we're coming down here to that 235 level. That's 40% and quite possibly more in 2024 or maybe 2025. So yeah, you're talking, let's just say to that fourth target, which still hasn't been hit, T4. 40% profit potential for again, I'm talking hypothetically because it hasn't happened yet. If you get an island cluster top or bearish engulfing candle and you shorted it, let's just say, you're talking a 2-3% stop to make, 40%. That's a phenomenal risk reward ratio. And again, the odds of playing out might not be super high, but it's worth it. So, all right, that's it, guys. Those are the things to watch for. Like I said, this market just kind of continues to hold up. The divergences are still very much intact. Therefore, my outlook hasn't changed. And I just know, talking to people and doing this a long time, people get frustrated, especially those that are already short, especially those that are heavy short, using leveraged ETFs and things like that. And at the end of the day, there are no guarantees that that this market's not going to continue to just power through these divergences and go a lot higher. I could sit here all day and make, a bullish case if I wanted to on things that, could take this market a lot higher. But that's not my, I look at all the evidence, technical and fundamental. That's just not the conclusion I'm coming up with right now. All right, guys, I'm going to wrap it up here, get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.